Welcome. I'm Jeff Stein. Jean, my wife and I go grocery shopping each weekend. Jean does the grocery shopping for her mother, and I do the shopping for Jean and myself using the list she shares with me. What struck both of us this weekend was the grocery shelves were full. In addition to a full selection of foods and produce, there was plenty of toilet paper, Lysol wipes, and paper towels. I can't believe we're even talking about this, but that's the world that we currently live in. 2020 was a fascinating year. Fascinating may be a poor way of putting it, but the bottom line is that we saw all kinds of things from public unrest to civil unrest, to the markets going way down, to the markets coming back, and in some cases hitting record highs. Today, we're fortunate to have Anthony Gerbi review the state of the markets with us. As many of you know, Anthony is our head of analytics with Stein Financial Group, and today he's going to be covering what took place last year and what we believe as an organization is likely to take place this coming year. With that, Anthony, I'd like to hand this over to you, let you take it away, and bring us up to speed on what we might be able to expect here. Thanks so much for taking the lead here.
Yes, thank you, Jeff, and welcome everyone to our 2021, what's now become a semi-annual tradition, our State of the Markets. We also do a companion piece to this in August. And as Jeff alluded to, what an interesting year we've all lived through. I mean, think back to where you were 365 days ago and how different the world was. I know where I was. We were in the office. We were seeing clients in person. We were monitoring, but not quite sure what to make of this development out of Wuhan, China, that there was this new disease spreading very rapidly. And wow, a whole year can make a big difference in perspective. What we are going to talk about today are the markets, the economy, how those things did, and maybe how we expect them to do going forward. I've got some disclosures for you. Feel free to pause the screen and read through those. I also will be more than happy to answer questions here. So if you have questions throughout the presentation, please ask. You don't need to wait until the end. You may use the Q&A or chat feature at the bottom of the screen if you like, or you can raise your hand as well. And we'll also get to questions at the end. So I wanted to get that off at the top. So there are four main questions today. How did stocks perform in 2020? If you've looked at your statements, you probably have an idea of that, but how exactly did they perform? What drove market performance in 2020? Where are we now? Because again, over the last 365 days, there's been a lot of changes that have happened. We're in a bizarre place. If you would have, ran this by me a year ago and said, this is where we'll be in February of 2021, I would have said, oh boy, we've got a lot of things coming down the pipe here. What do financial professionals, what do we forecast for 2021? Obviously, forecasts are predictions. They're not set in stone. They're not fact. There's no way we can know whether they'll come true. But it is helpful to monitor what the consensus predictions are because that helps to set the expectations in general. So today, we're going to first take a look at how a volatile and unprecedented 2020 unfolded and what 2021 might hold for investors. So here's a look at the I should start with this. No one could have predicted how the pandemic would roil the markets throughout the year. Stocks plunged in March and April from record February highs as global economies seized up following the economic restrictions and lockdowns put in place to control the spread of the coronavirus, right? We all know that. We lived through the closures and the lockdowns starting really in March here last year. But after that, after March 23rd, which was actually the low of the market for the year, it staged a massive rally. And as major stock indices repeatedly set new highs throughout the course of the final 2 months of the year. I mean, that's quite amazing. We closed at 3,756.07, and that would be points on the S&P 500. How to think about that? S&P 500 are the 500 largest stocks in the stock market. So the S&P 500 is an index. You may have heard of stock indexes that track how those stocks do in aggregate altogether. So what happened? Actual results. We closed the year at 3756 and plus 16.25% as of December 31st, 2020. So how did we get from a year like 2020 to a 16.25% return? I mean, that's amazing. How did that happen? It happened for a number of different reasons. And obviously, the dominant feature was the coronavirus pandemic. No surprise there. But what we also need to take into account is that the Federal Reserve changed interest rate policies. If you've gone to refinance a mortgage, and if you haven't, maybe you should, or you should look at it. If you've seen how low the rates are right now, we've also had an incredible home buying market, partially spurred on because of that. So that's one of the factors. Another factor is just the timeline. And here's an example of the timeline of 2020, some key inflection points here. Number one, when did the lockdown start happening? We've got the bottom there is March 16th, depending on which index you're looking at. I quoted March 23rd. It was about that week that we bottomed out here. And then we started to recover. And you can call the shape on this graph whatever you want to call it, a V. I've heard it called the square root symbol. Maybe that's more familiar to some of you as you've been helping kids with homework as they've been learning from home. But stocks started building on the previous year's gains, but dramatically reversed in March and April. That's that big drop you see. It was only after a series of unprecedented monetary and fiscal policy actions that stocks began their long climb back to pre-pandemic levels. What are we talking about? We're talking about the Federal Reserve cutting interest rates, stimulating the economy, and we're talking about the stimulus bill. And those two things combined with the idea that a vaccine was coming helped the market recover much more quickly than we've seen the economy recover. And maybe this is a good point to again do my tried and true differentiation of the market and the economy, right? The market, the stock market, is just the overall value of the companies that are traded on the stock market. What is a share of Apple worth? What is a share of Microsoft worth? Any company that's traded publicly has a share price. Now, the economy is much broader in a definition. Realistically, it's what we produce or what we consume, because those two things in one way or another add up, right? So it's how productive we are. And obviously, when we have a situation where much of the country is locked down, that productivity drops. That's what precipitated the stock market drop. We felt companies would be less valuable in a lockdown world. And that's was the sentiment. That's what bore true. But that we also saw the recovery that ended, at least at the end of the year, up 16.25%, which is an amazing recovery from where we were. You'll notice we've color coded our four key market drivers here, identifying dates where each of these factors move the market significantly. The S&P 500 is generally considered representative of the whole U.S. stock market, but it is important to remember it is only the 500 largest stocks. So I talked about the Federal Reserve. Here's just a chart to kind of represent that. The Federal Reserve was already on a path of lower rates in response to a slowing economy, implementing 3 rate cuts in the second half of 2019 as the coronavirus pandemic's economic impact became more and more apparent in March of last year, and amid a slumping stock market due to that same reason. The Fed implemented unprecedented reductions in the federal funds rate. That's just the key interest rate that sort of trickles up and determine the rates for the rest of the economy. So it's unprecedented. The unprecedented response wasn't limited to just cutting the federal funds rate. As we'll see in the next image, the Fed actually pulled several levers to address the immediate dangers facing the economy and capital markets. And here's just a summary of what this is. Now, feel free to pause, read through this timeline. I'm not going to go through all the different bullet points here. Don't worry, there's not going to be a test on this after. So some of this might seem a little esoteric, but don't worry. This is just kind of a summary of what happened. But what this creates is the impression of everything the Fed did to try to keep the economy moving forward, or to try to repair what was being damaged by the coronavirus pandemic, economically speaking. And it's an unprecedented slate of actions from them. It's not just cutting the interest rates to zero. It's, for example, establishing funding to support credit to large businesses and liquidity for outstanding bonds. I mean, they were all over the place trying to plug the holes in the proverbial dam that were opening up as our whole society had to move into slow motion last year. And by where we're sitting at today, it seems like those things worked pretty well. I mean, that would be my take on the situation. This is a chart, again, be thankful. We're not going to test you on this info at the end of the year. What I want you to notice is in the first quarter, so the middle of the graph, from the first quarter of 2021 to the fourth quarter, we saw a decline in corporate revenue, net income, and earnings. So obviously, that's what we would have expected, right? The pandemic has caused companies to make less money. But the key feature, and this is one of the big reasons why the economy, or excuse me, the market grew while the economy was still trying to recover, is that the projections for next year are all in the positive. And again, those are projectives. And actually, next year is now this year. We're talking about 2021. But they're projections, but that is what the stock market based its optimism off of after that March week from the 16th to the 23rd. So that's a key reason why we saw the market go up and the economy kind of stay down and not really grow back as quickly. And we got questions about that a lot last year. And that's kind of the same answer I was giving to all of you when you would ask me. I said, well, the stock market is going to front run what they feel the economy is going to do. That's the goal anyway. That's how they could get ahead and try to make money. Investors, that is. So what we're seeing here is basically what the assumption is that, okay, 2020, yes, bad year for the market, or excuse me, bad year for the economy. 2021, much better year for the economy. Let's start acting on that right now. That's kind of the general gist of what happened. So here's just a look back again. The economy suffered a deep contraction in 2020 as the pandemic led to economic lockdowns. Where I feel like I say that every slide, but that really was the catalyst for last year. Everything depended on the pandemic. So what you can see from GDP growth, and I don't get too bent out of shape about the quarter two and quarter three numbers. Our economy didn't grow by 33% in quarter three. That is what it grew in quarter three times 4 for an annualized rate. In other words, if it would have kept growing at what it did in quarter three, then the economy would grow by 33% in a year. So what those GDP growth numbers are an annualized number. But regardless, it tells the story, right? The economy shrank in the first 2 quarters of the year and expanded in the second 2 quarters of the year. And part of the expectation that I'm going to relay to you here is that we do expect the economy to continue to grow into the next year. Another key piece of information, a couple key pieces, labor market. Think of that like unemployment in this case. It was very low in the start of the year, and it skyrocketed in the second part of the year. There were so many people looking for jobs because they lost their jobs or because they were furloughed or all those different things that happened last year. The good news is that it's coming back down. Maybe not to where we were at the start of January of 2020, but it is coming back down, and that is good news. Inflation continues to be low. Consumer confidence, while not nearly what it was, and who could blame us, as Jeff mentioned at the top, when you're having to run around trying to find the last roll of toilet paper, that kind of shakes your consumer confidence a little bit. But it is coming back. And yes, there will be fluctuations. You can see quarter 4 consumer confidence. Perhaps that was election related. It's hard to untangle those numbers, but that's one possible explanation of it. But those numbers are coming back. And that's key for the economy because we have to participate, be active and willing participants for the economy and therefore the market to do well. And there's also some data here on manufacturing, which again, I don't think these numbers are surprising. We took some big hits last year. So where are we now? I just kind of took you through a whirlwind tour. I know that went very quickly, but you've looked at some of the factors affecting performance in 2020. Let's take a look at some of those headwinds and tailwinds that we've got facing us right now, and that might help us find out where we end up. So if you've come to one of these presentations before, I always have a slide like this. It is a group of 20 indicators. These indicators help forecast pressures on the economy and financial markets in the next 3 to 6 months. But you're saying, Anthony, wait a minute. I'm looking at the top of the screen and I see December 2010 up there. You got the wrong slide. You put the wrong one in. Well, what I put this in here for was to compare for you 10 years ago and now. So December 2010, things were actually pretty good. We were recovering from the 2008 crisis. Yes, our 2 worry spots were volatility and the political environment, but everything else looked pretty good. And by the way, history bore us out on that. Everything ended up being fairly good. I mean, there's always volatility and bumps in the road, but we were well on our way to recovering at that point. So now let's take the snapshot. January of 2020. And again, I know what you're saying. Wait a minute, it's 2021. Well, okay, we're going to compare 2020 to 2021. Give me a minute here. So January of 2020, pre-coronavirus, we had heard about it. It was in China, but we didn't really know what it was going to be like here, if anything. When maybe there wouldn't be an effect at all. Well, obviously we learned our lesson there. But this is where we were. And it was not quite as good as December 2010, right? There's more green in the 2010 picture than the 2020, but still pretty good. Political environment, negative. We all know what the political environment's been like for the last year. And geopolitical risk. I mean, we were talking about things like North Korea. You remember in the start of 2020, there was a whole worry about Iran and what might happen with them. And those feel like distant memories now, but that was what we were worried about. So now let's compare. And these are from November. They get updated about once a quarter, I believe. And compare it. Okay, we've got more red, right? So political environment, still negative. November 2020 will probably be remembered for being a very negative political environment. And that's whatever side of the coin you're on. Geopolitical risk, still an issue. It's not going away. Equity market valuation. Now, this is an interesting one. Equity market, why would that be, it was yellow in the one before, and now it's red. Well, ironically, it's not because the market was bad. What that means is that we're worried that the market might actually be too high, that the equity market valuations might be too high. We're valuing companies too much for what they're actually producing. That's not a statement of fact. That's an opinion. It's something we're thinking about, but it bears watching because we've had this run up in the market. That's one of the things that we're really keeping a close eye on. Obviously, the other red one, not a surprise here, disposable personal income. People who lost their jobs or who were furloughed or who had a disruption of any kind, they lost out on income. And that affects the overall economy when you consider that in aggregate. So there's a few things to worry about, but I want to point you out that there's really a lot of good what we're looking at here on this slide. And I view that as a great sign for where we are in the recovery of not just the economy, not just the market, but sort of where we are on the timeline of getting back to somewhere close to those January 2020 numbers. I don't know when that's going to happen. There's a lot of different uncertainty down the road here, but it seems like we are on track. And that is a very positive thing here. So headwinds, what do we have going on? Well, we've got the COVID-19 vaccine distribution, right? So they're a hugely positive step, no doubt about it, that may help speed the economic recovery. But there's a lot of outstanding questions around how quickly they could be distributed. We just had storms across the country that have really impacted that. Maybe some of you have had your dose pushed back because there was a supply chain issue. And there's also the worry about the different variants that are popping up and how the vaccines might be able to deal with those. I'm not a scientist. I can't answer those questions. I can just tell you it's something we're watching closely. Economic scarring, which is a very dramatic term. But we don't know how fast, this is what I mean by that, we don't know how fast Main Street businesses are going to be able to recover here, or how many may be unable to recover. Bars and restaurants especially hit so hard by this. Corporate balance sheets even for many industries such as travel and hospitality have been damaged in a way that may limit these companies' abilities to rehire workers or invest to grow or generate profits amid reduced revenues. I mean, it's not just the mom and pop shop, but it is the mom and pop shop. How are they going to be able to recover from this? Rising bond yields, and why that's a potential headwind is that sometimes has a correlation with the stock market. And sometimes they're going in the opposite direction. So it's something we're watching very closely because while bond yields may be expected to remain very low, many professionals actually anticipate that rates may rise above today's level as economic growth accelerates. So as we recover and the demand for credit bonds increases, rising yields could weigh on stock valuations, affecting the overall direction of the market. Again, not necessarily even a prediction encoded in that bullet point, more just a watch out. And finally, geopolitical events, and we could talk about anything. We could talk about North Korea. We could talk about Russia. We could talk about China and Taiwan. I'm not going to talk about that because I'm not a political science major. I'm an economics major. But At the same time, they're things that we're watching out for. So tailwinds. Now, I know what you're saying. Okay, you can't have the COVID-19 vaccine in both the headwinds and the tailwinds. Well, I kind of can. I did it. Okay, it's on the screen. And what I mean by that is obviously the vaccine is a huge boost to the economy as we try to get back to society as we knew it in 2020 before the pandemic. And whether we ever get there is up to you. You can make that decision for yourself. But continued monetary accommodation, that would be the Fed and interest rates. They're going to grease the skids, so to speak, to let the economy grow as best it can. Corporate profits coming back. I mentioned that on the downside before, where will they come back? But certainly some industries have had exceptional profits. The technology stocks, for example, did really well last year. And we anticipate a lot of companies will continue to do very well. So that's actually a good thing. Healthier consumer, both in wallet and in body, right? I mean, that affects how much we're demanding. Are we going outside? Are we willing to spend money? I don't know what your credit card bill did last year, but mine went way down while I was stuck inside the whole time. So as we go out and potentially spend more money, maybe take vacations once that's allowable again, that will help to stimulate the economy as well. Prospect of reduced trade tensions with allies in China. That's a self-explanatory bullet point. Will we get the same rhetoric and the same relationship with China that we had under the previous administration? Well, it remains to be seen. We don't know how that's going to shake out yet, but there's at least the prospect of a reduction in tension. And that could be a good thing on the tariff side of things. And moderate inflation. We looked at inflation for a brief minute a couple slides ago, and it really hasn't been an issue yet. It is something we're going to watch, but the fact that it's moderate right now is a tailwind for the economy. We're growing, but we're not just raising the prices of everything, which is what inflation is, to match that growth. We're having very moderate inflation. So I view all that as a good thing. Now, I talked about the equity market valuations in that speedometer slide, the one with the 20 dials on it. And this is where we're at today, or excuse me, September 30th, 2020. We are at well above, and this chart can get a little intense, so I don't want you to worry about the acronyms or anything. I'm happy to answer questions about it. But basically, what I want you to think about is where this line on the graph is. The higher it goes, the more value a stock has relative to its earnings. So if the line gets very high, that means we are valuing things per dollar of earnings much more than we have in the past. And why that's something we watch for is because when the stock market gets up high like that, it can be a warning sign that maybe you could use the word bubble potentially. That's not where I'm going to say that we're at, but that's what people watch out for. We don't want to get into a situation like that. So the average of that line over the last 25 years is 16.46 times. That's what the X stands for. As of September, we're at 21.54, well above one standard deviation above that. And I majored in economics, I minored in statistics, and I understand that not all of you are as interested and excited about this graph as I am. But what I'm taking away from it is, okay, things are expensive right now. The stock market's expensive. Does that mean it's not a good idea to invest in it? No, not necessarily. Does that mean, it's going to correct, it's going to go all the way back down? No, that's not necessarily what it means. What it means is we got to watch it closely. And maybe that's an unsatisfying answer, but that's really what I'm taking away from it. Vaccine expectations. Maybe we have some medical professionals on this call. I don't know. If you're watching and you are, thank you very much for all the work you've done. I am not one of you or one of them. And that means I can't tell you about how the vaccine works or about how effective it is or how, this or that metric. What I can tell you is the expectations for where we'll be and perhaps how that might impact the economy. So first off, first Americans received their vaccination on December 14th of last year. January 2021, and this was written before January, we're actually doing very well, as I understand, from the timeline of vaccinations. So basically, by the end of April of this year, President Biden has promised that 100 million Americans will get the vaccine. So whether that's going to happen or not, I don't know. It seems like we're on a good pace from everything I've read. But if that happens, it will be a boost to the economy, because as more people get vaccinated, as we can sort of reintegrate ourselves into the economy, that's what helps consumer confidence goes up. It helps us go out and spend the money that stimulates the economy. And that also, hopefully creates jobs. Servers and bartenders can go back to work. All that stuff is sort of contingent on the vaccine. That's why it's important to bring up. Forecasts. So I spent a lot of time showing you graphs that I think are interesting, and I hope you got something out of it, about where we are, what we're facing. But let's actually talk about what we are predicting. And again, they're predictions. We're going to have some experts' predictions on the screen in just a few minutes. But what I want to talk about is kind of how we go about making the predictions. And what this slide is actually talking about is inflation. And you might say, well, I don't see the word inflation except up on that corner. What you seem to be graphing is the consumer price index. Well, that's how we measure inflation. The consumer price index is an index that tracks prices. If it goes up, that means we're experiencing inflation. If it goes down, we're experiencing deflation. And I could do a whole hour on the weird and interesting implications of inflation. But suffice it to say, this past year, we have had an incredible decrease in the prices of energy. People aren't traveling as much. Oil prices go down. And oil is a very complex market that's not just a 1+1 equation, but that could be part of the reason why we saw energy go down so much. Food goes up. Well, what are we doing? We're all baking bread. I remember back in the spring, nobody had yeast. Everybody was baking bread, right? That's what we're doing. So food has gone up. That's one thing we've still been able to go out and do is grocery shop. So basically, inflation is one of the key indicators that the Federal Reserve uses in determining the level that they want to set interest rates at. Currently, inflation is below the Fed's target rate of 2%. That's kind of what they aim at. And we're below it, which is good because that means the economy's got more room to run before we worry about it overheating, so to speak. The Fed has said that absent persistent above target inflation, don't you just love how the way economists talk? Absent persistent above target inflation. So if there's not inflation exceeding their target, they do not foresee raising short-term interest rates anytime soon. So that's what they said. And, we have no choice, no reason not to take them at their word. But basically, that's why we're predicting lower interest rates for a little bit longer here. Now, this is a mix of this is just the forecast here. Forecasters are painting a mixed picture of the economy in 2021, indicating possibly a deceleration in economic growth. But remember, deceleration doesn't mean you're going backwards. It just means you're slowing down a little bit. In economic growth from previous forecasts, while expecting unemployment to fall faster. Remember, if unemployment falls, that's a good thing. We want more jobs, therefore unemployment goes down. Given what happened in 2020, it may be a relief that some expect the nation may see solid economic growth throughout 2021. This survey, which is what the data on the screen are about, was taken prior to the announcements of an effective COVID-19 vaccine. So it's difficult to say how much forecasters will alter the outlooks given the broad availability of a vaccine. If we've learned anything from 2020, it's that we're all just kind of taking it as it comes, and news has come so quickly and been so jarring that forecasts are getting updated all the time. So by no means am I locking this in. But basically, what I want to point out here is that we do believe the unemployment rate will shrink, and we do believe the economy will grow. And those are two huge factors in determining how the markets may do as well. Because when people go to work, they earn money and they stimulate the economy, right? They go out and buy things. And when companies or corporations earn money, they then, their stock could potentially go up. Their value could appreciate. So that's how this kind of web of connections actually works here. Unemployment and wages. So this is this is another graph that I just love. You can see the big spike on the right side here. This goes all the way back to 1970 with the unemployment rate and wage growth. And you can see kind of after the 70s, which we could do a whole 2 hours on how weird the 70s were economically. It was a very interesting time. But you can see most of the time, they sort of move opposite of each other. When unemployment goes up, wages goes down. Wages go down. That kind of makes sense, right? I mean, if there's people getting laid off, you're probably not also raising wages at the same time. That wouldn't be a very fair proposition. Well, we had a spike in wages and a spike in unemployment. And it's sort of a fake bounce, I'm going to say. Not because it didn't happen, but because the wage growth that we saw this year was actually more a factor of lower wage people either being let go or completely let go or furloughed. So when you take a survey, what's the average wage at your company? And you've now cut off the bottom of it. Well, it looks like the average wage went up quite a bit. Did it really? No, everybody's making the same amount. It's just we forgot to count the people who got laid off. So that's a little bit of what's going on there. But you see the magnitude of the swing all at once. I mean, even look at 2008. It was a very steep climb in the unemployment rate, but it was still much more gradual than we saw this year. I mean, it was just unprecedented. I'm the millionth person to say that, but it was unprecedented what happened this year. But at the same time, we've rebounded quite well on the unemployment side. I've hit that point a number of different times, but it's just such an important one that I want to highlight it. How well we've done at reducing the unemployment rate, which is, again, you want to reduce the unemployment rate. So here's what you're probably looking for, right? Here are some of the biggest firms making predictions about where the market is going to be at the end of the year. Now, extra credit, if you remember from when I told you where the market closed at the end of last year, it was 37.56. So if you remembered that, good job. You'll pass the test that I'm going to give you at the end of this. Just kidding. So this is where some of the big companies feel like we're going to be. You can see there's a range. Jefferies believes that we'll be right about where we ended the year at. And, I'm not here to say they're wrong, but there's certainly the consensus seems to be that we will grow. Not necessarily huge growth, but growth enough, that we'll see modest stock market growth going along with our modest economic growth. And that seems to be, of course, nobody knows for sure what equities are going to do. I mean, that goes without saying, but the predictions at this stage are just predictions. The key takeaway from this is that Wall Street seems to be pretty optimistic. And I think that should give us reason for optimism. You've seen this chart before if you've gone through any slideshow I've done. This is probably my favorite one. And last year is the case in point of why I show this. I couldn't have dreamed up a better year to prove my point as I present this slide. So what this is the bars that we're looking at are where the S&P 500, the largest 500 stocks in the stock market, where they ended up at the end of any given year back to 1980. So you can see as of 2020, we ended up 16%. What the dots, the orange dots are where the stock market was at some point during the year, or I should say a decline that we experienced at some point in the year. And what we see is that at one point we had last year a 34% decline in the stock market. Now you compare the dots here, that's only happened three other times, and tied since 1980. So we've got 2008, we've got 02, and we've got 87, I believe that is. And all of those had significant economic landmark events associated with them. This year did as well. But what this shows is that just because the market goes down does not mean it's going to stay there. Yes, you may have a year like 2008 where you have a big decline and the market does end up down a lot, right? That has happened. But we also have a year like 2020 where the market goes down by over a third and recovers and ends up 16% for the year. I mean, that's one of the most extreme swings on this graph, but it proves the point. Why is this important? Well, this speaks to what I tell all of you when we talk on the phone about investment strategy. Why is staying invested powerful? Because it allows you to participate in that recovery. It allows you to not get out at the bottom, but stay in as the market recovers. And again, nothing is certain. We didn't know that the market was going to recover last year. No one can know the future. But this is just one of those things that I always harken back to say, let's look at the history. Let's see where we've been. And last year, again, was the poster child of why this is important. So steps for you to take. I've gone through a lot today. Thank you for bearing with me. Keep us in the loop with your important life changes. Tell us about the concerns that you have. make sure that your important legal and financial documents are up to date. We can help you with all that, but we need to know from you what's important to you so that we can make it important to us. And that follows right on to steps for us to take. We're going to keep you informed, just like these presentations that we're doing. And if you have, by the way, a suggestion or a topic that you'd like to learn more about, please let us know. We'd love to do either a short video or maybe even a full presentation on it. So we're always looking for better ways to keep you informed. We're managing your investments, if you are a client of ours, according to your personalized strategy. That's a key piece of how we do everything. It's always customized to you, not a one size fits all. And stay on top of changes in the market environment and where prudent adjustments and make prudent adjustments, where necessary. That's, again, these are steps for us to take. So we are watching to see, hey, where are we? What are the headwinds and tailwinds? And how does that filter down directly to you? And that's kind of how we look at everything. We want to give you the best possible advice given the situation we're at now. And if there's ever an adjustment that needs to be made, we'll tell you. So with that, thank you everybody for being here. I'm happy to take your questions. As I do, please remember our contact information. We've got our phone number, email, and website up on the screen. We also have a Facebook. If you would like to follow us there, we'd love to have you as a part of it. We post all of our event invites and blog posts and things like that. So please check that out. And thanks, everybody.